All right, let's dive right into this explainer and look at the massive pile of gold sitting dead center of a high-stakes poker table today. That number you're looking at, nearly 37 million ounces, is exactly how much physical gold is currently tied up in active bets in the futures market. To put that into perspective, it is an unimaginably large slice of wealth. Literally, billions of dollars are riding on what happens next.
So naturally, you gotta wonder, who exactly is holding all the cards in this high-stakes game? Well, to figure that out, we are tearing into the U.S. government's latest COT report, the Commitments of Traders report from April 28, 2026. You see, this report forces every single major brokerage to show their hand, which lets us figure out exactly who is making all these massive bets and ultimately moving the market.
Think of us as market detectives for this explainer. We're going to decode all this complex behind-the-scenes data to reveal a clear, undeniable mathematical trigger. By the end of this analysis, you're going to know exactly what numbers to look for that tell you when it is finally safe to buy gold. No guessing, no emotions, just pure data.
All right, Section 1, the rules of the game for futures contracts. In this specific arena, there are basically just two directional bets you can make. Being long means you're betting the price goes up, and being short means you're betting it goes down. And you know what? We are completely ignoring those neutral spreaders today. We only care about the players who have a strong opinion.
Moving on to Section 2, meet the 4 players who actually move the market. So, out of the nearly 370,000 active bets currently on the table, our very first players are the gold miners, also known as the producers. These are the companies literally pulling physical gold out of the dirt. Because their entire business relies on selling gold, they are naturally long on physical metal. But to run a business safely, they need predictable revenue, right? So they sell futures contracts to lock in their profits at today's prices, just in case the market suddenly crashes tomorrow. Right now, the miners are net short by exactly 20,192 contracts. Basically, they've sold more than they bought just to protect themselves against a price drop. But here's the crucial thing to notice here. This represents very little change from last week. The miners added a tiny bit to their shorts, but overall, they're holding steady. They like the current price, but they aren't aggressively rushing to protect against a massive immediate drop.
Next up, we have what is arguably the most crucial player on the board, the giant banks. The data officially calls them swap dealers. These are the massive financial institutions acting as the middlemen for literally everyone else. They don't necessarily want to bet against gold, but when hedge funds demand to buy massive amounts of it, the banks are the ones who have to sell it to them. Because of this dynamic, the banks end up holding all the risk for the rest of the market. But check out the shift that just happened. Yes, the banks are still carrying a massive net short position of over 174,000 contracts. They're essentially acting as this giant defensive wall holding the price down. But look at the difference between April 21st and April 28th. They just bought back or covered nearly 8,000 of those short contracts. Guys, this is the very first sign in weeks that their giant defensive wall is starting to crack. They finally stopped adding to their shorts and started reducing them.
Then, player 3 steps into the arena. The hedge funds and algorithm traders, or managed money. Now, these guys are the momentum chasers. They aren't sitting around looking at the long-term value of shiny rocks. They are trend followers who buy simply because the price on the screen is going up. Historically, this is the exact group that provides the massive fuel to drive spectacular market rallies. And they are definitely still riding that rocket, remaining overwhelmingly net long with almost 90,000 contracts right now. But notice that key metric over on the right. They actually reduced their net long position by over 3,200 contracts this week. They sold longs and even added a few shorts. This tells us they are finally taking some profits off the table. It's the first real crack in their bullish armor, signaling that the engine driving this rally is starting to sputter just a bit.
Finally, we've got the fourth group, the everyday retail traders. These are the regular folks trading from their laptops at home, officially categorized as non-reportables because the government doesn't track them individually. In the financial world, retail traders are notoriously famous for being late to the party. They see gold making headlines on the evening news and they rush in, often ending up buying right at the very top of the market and cheerfully holding the bag.
They are heavily betting that gold is going straight to the moon. But reality is starting to set in. Just between last week and this week, their net long position dropped by almost 3,700 contracts. The everyday trader is finally starting to get scared. They're beginning to panic and actually leave the market, which is exactly what needs to happen before a true market bottom can form.
This brings us to Section 3, the zero-sum math.
perfectly balanced.
You see, unlike the stock market, the futures market is a mathematically precise zero-sum game. For every winner, there is an exact matching loser. It's perfectly balanced. If you add up all the long bets bought by hedge funds, traditional institutions, and retail traders, you get exactly 194,813 contracts. Now, who sold them all those contracts? The giant banks and the miners, whose total short positions add up to exactly negative 194,813. Every single ounce of bullish enthusiasm was absorbed and sold directly to them by the banks and miners.
Next is Section 4, the concentration of power among the big players.
Now, this poker game isn't exactly what you'd call fair. Just look at this breakdown. The top 8 biggest traders in the entire world, and we know these are mostly massive banks, control over 51% of all the short contracts in existence. A handful of billionaires control the majority of the selling pressure. This means they have the firepower to cap any gold rally at will. Until this heavily concentrated percentage drops, the banks are the ones steering the ship.
All right, Section 5, the momentum shift, looking at the weekly changes.
The static numbers only tell you where things are right now, but the week-over-week changes, that tells us where things are going. Just look at what went down over a single week. The banks covered nearly 8,000 of their shorts. The hedge funds, the main engine of the rally, sold off over 1,400 longs to take profits. And retail traders dropped almost 3,000 long contracts as fear started to creep in. New money is still entering the market, sure, but the big players are changing sides. Make no mistake, this right here is exactly what the very beginning of a major trend change looks like.
Which finally brings us to Section 6, the final verdict. What should you actually do?
So, is it finally time to push all our chips into the middle? Well, the definitive, purely data-driven answer right now is no. Absolutely do not buy yet, you should stay in cash. And here's why. Because despite the healthy progress this week, those hedge funds are still holding nearly 90,000 net long contracts, and retail is still heavily trapped on the long side. There are simply far too many weak hands holding on to hope. They need to be completely flushed out in a price drop before a true safe foundation is built for the next massive run-up.
Here is your ultimate strategy. You don't have to guess when the bottom is in. You only buy aggressively when these 4 precise mathematical conditions perfectly align. Number 1, managed money net longs drop below 70,000. Number 2, swap dealer shorts fall below 165,000. Number 3, retail longs get flushed down to 25,000 or lower. And 4, total open interest stops falling and starts rising again. When these 4 hit, the latecomers are gone and the coast is clear. Right now, the absolute most vital of those triggers is the hedge funds, the managed money. We need their net long position to drop from its current level all the way down to 70,000. Doing the math, that leaves us exactly 19,752 contracts away from a completely safe, mathematically sound entry point. At the current pace of selling we saw this week, we are roughly 4 to 6 weeks away from hitting that golden target.
So, please, lock this mathematical trigger in your mind. Managed money net long dropping to 70,000 or below. As we eagerly wait for the next Commitments of Traders report coming out on May 5th, ask yourself this. Will the momentum accelerate and finally force the weak hands to fold entirely, or will they stubbornly hold on to a losing hand? Keep your eyes on the data, follow the smart money, and wait for the absolute perfect hand to play.